So how to avoid getting your shares called away when writing covered calls? Well, there's really two ways that you can avoid getting your shares called away when writing covered calls. The first way is when buying the stock in the first place and selling the call option against it, choosing the right strike price is what's really going to help you avoid getting your shares called away. That's the first step. So if you really want to keep your shares, if you don't want your shares to get called away, you need to choose a strike price that will be out of the money come expiry date. So let's say you buy a stock at $50. There's a very good chance that the stock stays below 55 at expiry date, which is let's say in 30 days. So if you think there's a good chance that the stock stays below $55 come expiry date, then you should choose a strike price of $55. This way you'll collect any call premiums that you can. Obviously, the further out you are from the current market price, the smaller the premiums, but at least you collect something and you keep your shares, or you give yourself a good chance of keeping your shares. If you're really certain that the stock is going to drop after you buy it, so you buy at $50 and you know that the stock for sure in 30 days is going to be in the 40s, well then you could choose a 50 strike price or 51 or 52. So choosing the strike price initially is what's really going to help you keep your shares. And it all depends what you think the direction of the stock is for the next 30 days. But if you want the highest return monthly, it's best to sell an at the money call option. So if you buy a stock at $50, it's best to sell a call option at a $50 strike price. Whatever happens. If the stock is trading at 50.01, you're going to lose your shares come expiry date, but at least you collected the highest premium possible, and you could do it again the following month. You get your money back, and then you could do it again by either the same stock or another stock that pays 3 to 4% by selling an at the money call option. What really sucks though is if you buy a stock at 50 and you sell a call option at a 55 strike price, collecting the small premiums, but then the stock drops to 45 come expiry date. So now you have a stock that's down 10%. You collected the premiums already. You get to keep your shares, so that's good, but you're owning shares of a stock that's down 10%. And then if you want to sell call options again the following month, you won't be able to choose a 55 strike price, that's for sure, because the premiums will be very low. You're going to have to get closer to 50 or even closer to 45 to sell decent call premiums or to collect decent call premiums. So then you have the risk of getting your shares called away at that strike price of the following month. So strike price really is important to choose the right strike price from the beginning. And what's really going to help you choose the right strike price is actually buying the stock at the right price. So if you buy a stock that's a quality stock that's cheap, that's been hammered and took a big drop, most likely it's going to come back up. So if you buy a discounted stock, then it's going to help you choose the right strike price, definitely an out of the money strike price, because you expect the stock to go up. So you want to collect some capital appreciation by choosing a strike price that's higher than the purchase price or the market price. So another way to avoid getting your shares called away is to buy back the options, which I don't like doing, and I'll explain why. So let's say you buy a stock at $50 and you sell the call option at a 50 strike price. You collect, let's say, $2. Come expiry date, the stock is trading at 50.01. So that would mean that your shares are going to get sold at $50. So instead of letting your shares get called away, which is not a big deal, you could buy back the option, which will probably be worth a penny or 2 pennies. So you sold the option for $2, you can buy it back for a penny or 2 pennies, and then right away, same day, you can sell the following call option you can sell the call option for the following month. This way, you keep your shares, your money is still in the same stock. You collect call options the first month, and then you can collect call premiums the second month. What if you buy the stock at 50, you sell a 50 strike price call option, you collect $2, let's say, but then come expiry date, the stock is trading at 52. If you want to keep your shares, well, first of all, you chose the wrong strike price initially because the stock went up and you sold at a 50 strike price. So if you really must keep your shares for some reason, you're going to have to buy back the call option, which at expiry date, if the stock is trading at 52, they're going to be worth around $2. The $2 premium that you collected, you just gave it back by buying back the option at $2. Even worse, if the stock is trading at 54 and you want to buy back the option and you want to keep the shares, you're going to have to buy back the option, which is going to cost you $4 at expiry date. So you bought a stock at 50, you collected $2, but then you paid $4 to keep it. So your final cost of the stock is $52, but your stock currently trades at 54. So whether you let your shares get called away or buy back the option at expiry date because the stock went past your strike price, you're going to end up in the same position. But what if you buy back the option? The stock was trading at 54, so you decided to buy back the option, pay $4, and then the stock decides to drop back down to 50 or 52. So now you bought a stock at 50, you collected $2, you paid $4, increasing your cost basis, making your cost basis now at 52. Let's say when you had bought back the call option at $4, you immediately sold a call option at a 54 strike price, and you collected $1, let's say. So your true cost basis is now $51, but the stock is trading at 52. So you're up $1 on the stock overall in 2 months. So as you can see, when you start buying back the options, especially higher than what you collected the first time, it becomes a little messy and sort of defies the purpose, because the purpose is to collect a premium every month. But when you start buying back the options, you can wipe out your premiums that way, even if you're not losing money overall, but you're not making money either. So the best way to avoid getting your shares called away is choosing the right strike price to begin with. So if you're someone that wants to keep a stock forever, then you're always going to have to sell a far out of the money call option. So if you buy a stock at 50, you always want to sell the 55 or 56 strike price call option. So hopefully in the next month, the stock doesn't go past 55. But even if it does go past 55, you could probably buy it back, and it'll be, if it goes past 55 by a few pennies, then you can buy it back and still keep your shares. It might be worth it in that case, because you're keeping a stock that has a $5 appreciation, 55 minus 50. And then the next month, if the stock is trading at 55, then you don't sell at 55 strike price, you sell at 60 or 58 strike price. So you always want to pick a strike price that's far from the current market price when you sell your call option, if you really want to keep your shares. If you do that, you're going to collect smaller premiums. Basically, if the stock is paying dividends, you're basically going to be doubling the dividend rate by selling call premiums, by selling call options that's far out of the money. So that's really the best way, in my opinion, if you want to keep your shares forever, never get called away, is to pick the right strike price to begin with. And if you have to, you can buy back the options depending on the scenario, depending on why you want to keep the shares, and depending on how far off the strike price the stock is trading at currently. So in your brokerage account, if you're using Questrade, for example, when you buy a stock and you sell a call option against it, or write a covered call, same thing, you're going to see two positions. You're going to see two lines in your positions. So the stock, the 100 shares, and you're going to see the call option right under it. So if you want to buy back the option, you simply just click on the call option position, and then you just pick the price that you want to buy it back at and send order. And you're going to see that it's at the order confirmation page, it's going to say buy to cover or buy to close. Because when you initially sold the call option, when you initially wrote the call option or the covered call, you sold to open. So to close that account, you need to buy to close. To close the position, you're going to need to buy to close. So you simply just click on the position that you already own, the call option position that you already own, click on it, buy it, send order confirmation. And before you send, of course, you're going to see in the window confirmation or the order confirmation, you're going to see buy to close at whatever, 5 cents or 10 cents. When you do that, then your shares you can keep. You don't have to sell. They're not going to get called away at expiry date, because there's no more obligation anymore. You remove the obligation by buying back the call option. So then you have the choice to either write another call option at a different strike price or at the same strike price, or you can sell the shares on the market directly. So actually on March 15, when I had a bunch of options expiring, I bought back a lot of them just to sell the shares immediately in order to avoid the $25 fee of getting called away. So I didn't buy back the options because I wanted to keep the shares. I bought back the options just because I wanted to avoid the $25 fee. So knowing that at expiry date, when you buy back the option, you're basically paying for the difference in the current market price and your strike price. So the call option is going to cost me $2 to buy back. Well, I'm going to get that $2 back when I sell the shares immediately on the market, because the stock is trading, let's say, $2 above my strike price that I chose initially. So that's how, in my opinion, you can avoid getting your shares called away. So if you have any questions, leave them in the comments section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250. And it is tax season. If you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below. Thanks for watching.